Hi there and welcome to Chapter 2. So in this chapter what we're going to do is take a bit of a deeper dive into the balance sheet, which is a very important financial statement that we introduced in Chapter 1. So in this chapter we've got two primary learning objectives. The first is going to be to identify the sections of a classified balance sheet. And second will be to start using ratios to evaluate a company's balance sheet. So let's get going with Learning Objective 1, which will be covered in this video, to identify the sections of a classified balance sheet, and Learning Objective 2 will be covered in the next video. So as I introduced to you in Chapter 1, a balance sheet presents a snapshot at a point in time of the financial position of the company. It identifies the assets, liabilities, and shareholders' equity. And in order to improve understanding, what companies will do is will group similar assets and similar liabilities together to come up with a bit of a structured approach to the financial statement. So our standard classifications for a classified balance sheet basically includes, on the asset side, current assets, long-term investments, property, plant, and equipment, or PPE, and intangible assets. On the liability side, we've got current liabilities, long-term liabilities, and stockholders or shareholders' equity. So here's an example of a balance sheet from Franklin Corporation at October 31st, 2022, and you can see here that we've got a number of assets in the current assets section that goes from cash to debt investments all the way through to prepaid insurance. We've got some long-term investments like stock investments or real estate. Then we have property, plant, and equipment, the typical things like land and equipment, less accumulated depreciation, which we'll talk about in another chapter, and then intangible assets like patents. On the liability side, we've got current liabilities that include notes payable, accounts payable, all the way through to interest payable. And we'll talk more about these in another video. Then we also have long-term liabilities that include mortgages and notes payable. And then we have shareholders' equity that includes common stock and retained earnings. So now we'll talk about each section in a bit more detail. Current assets are those assets that the company expects to convert into cash or use up within a year or the operating cycle, whichever is longer. And the operating cycle is the time it takes from the purchase of inventory through the sale of goods and then collection from customers. So if you think about a year, and we break our year up into months, we kind of have short operating cycles that are monthly, but we usually will then report an entire fiscal year as just out of convenience. And the common types of assets that are considered to be current will be cash, certain kinds of investments, accounts receivable, inventory, prepaid expenses, etc. So here's an example of Southwest Airlines balance sheet and their current assets section that includes cash and cash equivalents. And cash equivalents are certain types of marketable securities that are quickly converted into a readily known amount of cash. So these would be things like term deposits or GICs. And then we have short-term investments that aren't quite as liquid and could represent things like certain trading investments and such. Accounts receivable, inventories, and prepaid and other current assets. And if you're looking at the scale, this is in millions. So Southwest Airlines current assets total over $4,498 million. That's a lot of current assets. And once again, current assets are listed in the order they're expected to be converted into cash, or as we said in the last video, in order of liquidity. Now, long-term investments would be things like investments in stocks or bonds that the company expects to hold for longer than 1 year. Other long-term investments might be investments in land or buildings that the company isn't operating or using, or might be saving for sale. And then there's notes receivable. Here's an example from Alphabet Inc.'s balance sheet. They have about $5 billion in non-marketable securities as a long-term investment. And then the property, plant, and equipment section. This is where we have the productive assets that we use to run our business. The only reason the company will buy assets in the first place is so that it can produce something or provide some kind of good or service. Property, plant, and equipment are assets that have long useful lives and we can't expense them right away. They're used in the operations and they would include land and buildings and delivery vehicles, factories, etc. Property, plant, and equipment for the most part is depreciated on some basis to spread the cost of acquiring that asset over the life that it is expected to generate revenue. And what happens is, as an offset to the particular property, plant, or equipment, you'll see this account called accumulated depreciation, which is an accumulation of the amount of depreciation that has been expensed so far. And we'll talk about that more in a future video. Here's an example of Cooper Tire and Rubber Company's balance sheet. Their section of property, plant, and equipment includes land and land improvements and buildings and machinery, molds and rings less one whole number for accumulated depreciation, and this is in thousands. So their total property, plant, and equipment is about $864 million. And then finally, the last asset classification would be intangible assets, and these are ones that don't have any physical substance. We can't touch them, and they include like goodwill or patents or copyrights. And if we look at Walt Disney Company's balance sheet, their intangible asset section and goodwill would include, franchise intangibles and copyrights, accumulated amortization on these franchises and copyrights, certain licenses from in the US, the FCC, or in Canada, it could be the CRTC. We have trademarks, etc. And then there's also goodwill, which we'll talk about in another video as well. So Walt Disney's balance sheet has $34 billion in intangible assets. That's a lot of intangible assets. So let's get into an example now where, similar to what we did in video 1, is we had a group of accounts or items that we'll classify into a classified balance sheet. So Baxter has these accounts that include prepaid insurance, cash, equipment, debt investments, inventory, accumulated depreciation for equipment, accounts receivable, and trademarks. So to turn this into a balance sheet, of course, we will start with the correct title. So Hoffman Corporation, balance sheet at December 31st, 2022. We start with the assets section, wherein we'll list current assets first, and in order of liquidity, start with cash for $800, accounts receivable for $1,100, inventory for $3,400, and prepaid insurance for $2,300, giving total current assets of $7,600. Then our long-term investment section, we'll have the debt investments for $2,100. Then our property, plant, and equipment section, where we'll show equipment at a cost of $10,700, and then deduct accumulated depreciation of $2,700 for a net of $8,000. Then we have a section for intangible assets. In this case, we only have one, the trademark, for $4,700. So all in, total assets for this company are going to be $22,400. Now we'll look at the liability sections. So we have current liabilities, just like we have current assets, we'll have current liabilities, and those are obligations to make payments on debts within the next year or the operating cycle, whichever is longer. And these will include accounts payable, salaries, interest, etc. They can also include maturities of long-term debt obligations like mortgages or bonds that come due within the next year. So looking at Alphabet Inc.'s balance sheet, here we have a set of current liabilities that include account payable, short-term debt, compensation, benefits, and other accrued expenses for a total of $19,310 million. In addition to current liabilities, we also have long-term liabilities, and those are obligations that come due in longer than 1 year, and those can include mortgages and bonds, lease liabilities, pension liabilities, etc. And if you look at Nike's balance sheet for long-term liabilities, they have bonds payable and some other deferred income taxes and other items for a total of $7.3 billion. Finally, we'll look at the shareholders' equity or stockholders' equity section that includes typically common stock. You can also see preferred shares there, and those are the investments of assets into the business by shareholders. And finally, as we saw in the previous video, retained earnings, which is an accumulation of undistributed profits retained in the business for future use. Here's a little exercise for us to do to match the account names and their classification as to whether or not the items that we're going to see come up next end up on the balance sheet. So we'll be classifying either current assets, for example, current liabilities, intangible assets, etc. So we'll start with this example with salaries and wages payable. Anything that's payable is basically a liability, and usually they're current liabilities. So salaries and wages is a current liability. Investment in real estate, well, investment's the key word there, so that would be a long-term investment. Unearned service revenue is something we haven't talked about yet. We'll learn more of that in another chapter, but basically that's a current liability. Unearned revenue typically is the result of, let's say, deposits given to you by customers for work that you haven't done yet. It's a liability because if you don't do the work, you either have to give the money back or do the work. Next one is debt investments, short term. Well, everything that's short term means it's current, and we're talking about debt investments, so that's an asset, and it's going to be a current asset. The mortgage payable due in 3 years. Well, payable is a liability. A mortgage is typically a long-term item, and it's due in over 3 years, so that means it's a long-term liability. And then finally, accumulated depreciation. That's an offset to property, plant, and equipment, so that's where we'll find it. It's PPE. Some other items that we can look at to classify would be service revenue. Now, revenue is actually on the income statement, not on the balance sheet, so that would be an NA. Interest payable. Payable means liability, and that falls into the current liability classification. Goodwill happens to be an asset. It's an intangible asset. Depreciation expense. If it has the word expense on it, it's not going to be in the balance sheet. It's going to be on the income statement, so that's an NA. Retained earnings actually is on the balance sheet in the shareholders' equity section, so SE. And then equipment belongs in property, plant, and equipment for PPE. So that brings us to the end of Learning Objective 1 on a bit of a deeper dive into the balance sheet. Now you can go ahead and proceed to the next video where we'll look at using ratios to evaluate a company's balance sheet.